Meta just watched its stock fall almost 9% in a single day, landing within a few dollars of its 52-week low. Revenue is still growing 28% a year. So why is the market this frightened? Capital spending is exploding toward $130 billion. Free cash flow has already collapsed to $41 billion, below what the company earned 2 years ago on far more modest revenue. The case comes down to one question. Is this spending building the next engine, or burning shareholder cash in an AI arms race Meta cannot afford to lose? By the end, you will know what that capital furnace is doing to returns, whether the advertising moat still holds, what the business is really worth against a $534 price, and the single risk that decides whether this is a bargain or a trap. The entire company is one idea, the largest pool of human attention ever assembled, rented to advertisers. Facebook, Instagram, WhatsApp, and Messenger pull in billions of daily scrollers, and roughly 99% of revenue comes from ads sold against those feeds. That is the business in a sentence. The split is blunt. Family of apps produced almost $199 billion last year. Reality Labs, the headsets and metaverse effort, added just over $2 billion. That is a 99-to-1 divide. Reality Labs is not a business yet. It is a research program that sells a few devices. Here is the vulnerability. Meta is a single product company wearing 4 apps as a coat. A downturn in ad budgets, a regulatory hit to targeting, or a shift in where people spend attention strikes almost all of revenue at once. There is no second cash-generating leg to lean on. The growth record is genuinely impressive. Revenue climbed from $118 billion in 2021 to $201 billion in 2025, and the trailing figure now sits at $228 billion. That is compounding of roughly 14% a year at enormous scale. The path was not smooth. Diluted earnings per share fell from $13.77 in 2021 to $8.59 in the 2022 crisis, then rebuilt to almost $24. Trailing earnings now stand at $26.54. From the trough, profit roughly tripled in 3 years. The margin story is where the mood shifts. Operating margin cratered to 24.8% in 2022, recovered above 42% by 2024, and has now slipped back to 38% trailing. Rising depreciation and heavier research spending are eating the profit the ad engine still throws off. Return on invested capital tells the truest story. It ran nearly 27% in 2021, rebuilt to 25% by 2024, then fell to 17%. Invested capital ballooned from $224 billion to $342 billion, and returns on that swelling base keep sliding. The balance sheet changed character fast. Meta was effectively debt-free as recently as 2021. Net debt has now swung to $97 billion, and off the books, future data center lease commitments reportedly reached around $279 billion. It is levering towards something far more committed. Cash flow splits into 2 stories. Above capital spending, conversion is superb, operating cash flow of $130 billion. Below it, free cash flow has fallen to just $41 billion, a yield of only 3%. That gap is a deliberate reinvestment choice, not an accounting quirk. And this is the choice. Capital expenditure went from $19 billion in 2021 to $89 billion on a trailing basis, with management now guiding to $130 to $145 billion for 2026. That is not a step up, it is a regime change. Everything else gets squeezed to fund it. Buybacks tell the clearest story. Repurchases ran $44 billion in 2021, but only $12 billion over the trailing year. The buyback has roughly halved exactly as the capital bill doubled, and it slows precisely when the stock is cheaper. Even at a reduced pace, the repurchases still shrink the count. Weighted diluted shares fell from 2.86 billion in 2021 to 2.57 billion, a 10% reduction that meaningfully lifts per share value. Fewer owners of a growing profit is the quiet compounding engine. The dividend, begun in 2024, is a rounding error by design. The payout is about $2.11 per share, costing roughly $5 billion against $60 billion of net income, a payout ratio under 9%. Easily sustainable, but never the real story here. Still ahead, where fair value lands and the one risk that could break the thesis. For now, why the core business is so hard to dislodge. The moat rests on network effects. People use these apps because everyone else already does, reinforced by a decade of behavioral data. The economics prove the moat is real, not just a good spell. Gross margin has held above 78% every single year and sits at 81.7% today, because showing one more ad to one more user costs almost nothing. That scale converts directly into margin. The backdrop is mixed. Global advertising growth is cooling toward roughly 5% next year, though social specifically may run hotter, near 15%. Meta's own 28% growth outruns the market, which means it is taking share. But a slower pie leaves less room for error. The harder cycle is the AI infrastructure race, running white-hot across every hyperscaler at once. Meta's proposed compute venture would lease spare capacity to outside customers, with talks reported to supply Anthropic in a deal worth up to $10 billion. But it enters against entrenched cloud giants from nothing. Sentiment sits near a floor, and the price action says so. The stock trades around $534, about a third below its high near $790, just above its 52-week low. A one-year return of minus 23% shows how much fear is already priced in. The trigger was the latest quarter. Earnings missed at $6.18, revenue guidance came in light, free cash flow collapsed, and the capital floor rose. JP Morgan cut its target and moved to neutral. The catalysts that matter now are datable: a signed compute contract and the quarter free cash flow re-expands. What is it actually worth? A discounted cash flow hinges almost entirely on when spending normalizes. Assume capital expenditure eventually settles back toward 25% of revenue and normalized free cash flow lands near $60 billion, and the model points to roughly $555 to $580 per share. The ad franchise is stable enough that an earnings multiple may be more trustworthy. On realistic earnings of $25 to $27, the stock trades around 20 to 21 times, not the 16 a stale consensus implies. A fair 19 to 23 multiple yields about $520 to $660. Wall Street still models a steeper climb. Consensus sees revenue rising from $253 billion in 2026 to $358 billion by 2028, with earnings per share of $32.93 in 2026, reaching $40.66 by 2028. Those figures look high against the actual quarter. Blend the three lenses, weighting the earnings multiple heaviest with the cash flow and EBITDA checks behind it, and fair value lands roughly between $500 and $635, midpoint near $568. Against $534, the stock sits about 6% below that midpoint. The largest risk is that the spending simply never earns its keep. Watch return on invested capital. A further slide toward 12 or 13% while invested capital keeps compounding would mean value destroyed at the margin. Add the $279 billion in lease commitments, and the base case drifts toward $400. The second risk is the ad cycle itself, with nearly all revenue tied to advertising. A recession or a regulatory blow to targeting would hit growth just as margins are already compressing. Yet the upside is equally real. If targeting gains lift revenue per user while spending plateaus, free cash flow re-expands sharply. Here is where it lands. On the evidence, Meta looks fairly valued with a modest margin of safety, trading roughly 6% below fair value and near its 52-week low. A wide moat ad engine growing 28% is not priced aggressively. The market simply refuses to pay for the AI bet. It derates further only if that spending becomes a permanent tax on returns. This breakdown is educational analysis, not investment advice. Nothing here is a recommendation to buy or sell any security. Always do your own research and speak with a licensed financial professional before making any investment decision. If this deep dive helps sharpen your thinking, subscribe for more like it, and drop a comment telling us which company we should break down next. Your suggestions genuinely shape what we cover. Thank you very much for watching, and we'll see you next time.